Hello, everyone, and welcome to the Upside Ticker Talk episode 5. We're super excited to be back for another episode today. And as you can see, we're in another studio. This is actually our third shooting location, so we're somewhat of a traveling circus. But I think we've got a great spot set up. And we've also got a great guest joining us today, which I'll be introducing in a few seconds. We've just wrapped up the third quarter, if you will, in markets. Fall season's rolling around. Markets have performed very well. We've also seen the Canadian ETF industry hit new record highs in terms of assets and in terms of flows. So it's been a really exciting, I'd say, quarter that's just wrapping up. And today's episode, we're going to be taking a deeper dive into portfolio construction with the help of ETFs. Obviously, we are ETF biased. And I guess might as well introduce our guest joining us today, Cameron Chamberlain. He's our Director of Portfolio Solutions here at Fidelity Investments. Has been at Fidelity for close to 10 years, if not more than 10 years. So Cam, thanks so much for joining us.
Thank you very much. Yeah, thanks for having me. Really excited to be with you today and talk all things ETFs and portfolio construction.
It's great. We were looking forward to this one because we have done content in the past together. It was audio only. Now we're actually sitting down together. We're going to have a good conversation. I won't, pick on you too much. I know we've got a big hockey game tonight planned, opening night for Canadians and the Leafs. Hopefully the Canadians win. I was going to talk about the Blue Jays for banter, but you kind of brought up a good point. Let's not jinx them, because when this episode's going to come out, hopefully they're still in the playoffs. So yeah, let's leave that to the side. But no, jokes aside, thanks again for joining us. Before we get into kind of the conversation with Cam, as usual, we always recap our last episode, which was a really awesome episode. We had the chance to host Patrick McIntyre, who's kind of the head, if you will, of the largest market making desk in Canada at National Bank. So we talked basically what the role of a market maker is, how they interact with investors, with advisors, portfolio managers, institutions, and basically ensure that there's a competitive and liquid market for Canadian ETFs. If you haven't had the chance to listen to that one, you can go on our YouTube, your favorite podcast app, and you will find it there. So that was a really cool one. I actually don't usually listen to a lot of our episodes back, but this one, I don't know why. I listened to the whole thing in the car, and I thought it was a really cool one. So anyways, all that aside, so let's get right into it. We always start with some key market headlines. Cam, I'll get your thoughts on some of those key points that we've highlighted over the past month. A few things I'd written down here. The last time we recorded when I was with Patrick, it was actually the day of the Fed decision. So basically, it came in line exactly with what markets were expecting. Markets have somewhat priced that in. If we look at futures and definitely overnight index swaps for rates, very good performance, as I mentioned in the introduction there for markets. The TSX was up more than 5% over the last month. Year to date total up more than 25%. NASDAQ, S&P 500 hit all of them hit new highs over the past month off the back of a continued momentum in like this AI trade, if you will. We just heard recently this week with AMD announcing another big agreement with OpenAI. You had some similar announcement actually from Oracle and other firms in the US. And really this train just keeps on going, and it's being reflected obviously in the indices that have higher allocations to infotech, comm services, and other sectors that are affected by that, including utilities. Other couple key points that I'd written down here to make sure I don't want to forget anything. Equity markets globally, and I say globally because now we just talked about US, Canada. Emerging markets have had their largest single month rally in the last 15 years. That's something actually, Cam, I might as well pass it over there, because obviously when you guys are building portfolios, you are considering, globally diversified portfolios. How's that? How have you guys reacted to that? Because it's been really interesting to see that develop on the emerging market side.
It's been a common talking point because so many of the portfolios that we look at and help build have historically tended to skew towards North America, not even just ignoring emerging markets, but international developed markets as well has been out of favor for a little while. And the Canadian and US equity markets have been a pretty good pair trade to some extent as a diversifier to play off of one another over the last few years. So definitely this year, I think, has been a bit of a wake-up call for many investors, realizing just how little exposure they've had in international markets more broadly, but certainly in emerging markets. The other thing that I've had my eye on a little bit recently is, it's tough sometimes to take a historical view, but I go back, sitting 3 years ago, you're late 2022, rapidly rising rates, the 60-40 portfolio is dead, everyone sell bonds and go to cash. And you look now and over the last 3 years, even just the investment grade bond market in Canada is kind of mid-single digits. Like, you're outperforming inflation. outperforming cash assets. And so while it's not a crazy double-digit return, and certainly you'd rather have been an equity investor over that period, there is a benefit there to whenever markets kind of go a little haywire and you get a little nervous, to kind of take a step back and ask yourself, if I could fast forward 3 years, am I going to be happy with the decision that I make today? And to some extent, are there risks that I'm introducing to my portfolio by making some holistic changes? So certainly recently, international markets are a big one, but sometimes I like to look a little bit further back as well and just reconsider where we are today.
No, for sure. And you're exactly right in the sense like it had been a while since we've seen kind of this sharper rally, if you will, in international, definitely, which is something we've talked about a bunch of times on the podcast this year, just because in terms of the flows story, it's been there. And I'm going to mention it again. It continues to lead the way. But bonds is another good point too, right? Like if you look at, a bond ETF, you've basically earned the stated yield to worst or yield to maturity that they're highlighting, or the distribution yield, which is like, there hasn't been a ton of capital gains, but it's been doing what it's supposed to do to a certain extent, which has been a welcome sight post 2022, obviously, which was much more challenging. Last couple points I had with regards to markets: oil prices been declining, fairly rapidly over the past couple months, but we just had actually OPEC announce a slightly lower expected production hike, so actually a little bit of a rally there. And that actually now, if you look at like other commodities, gold's been on an absolute tear. Gold hit over $4,000 an ounce for the first time in its history this week. That's been like this kind of safe haven asset, I think, for a lot of investors. That I feel like that was kind of like that's maybe what your parents looked at back when when they started investing. It's like, let's buy a little physical gold, let's throw it under the mattress.
Old school crypto, right?
Yeah,
it's old inflation hedge. It's 50% year-to-date return. Bitcoin and other cryptocurrencies have been up big so far in 2025. Yeah. And so for those trying to build diversified portfolios that consider these different asset classes, certainly they've been rewarded if you were considering them early. And you have seen a little bit of that momentum trade, I think, take hold over the last few months. And
it's actually, I mentioned earlier, the Canadian market's been doing well.
Mm-hmm.
The best sector in the Canadian market's been materials by far. We have a very heavy tilt towards precious metals. So if you own, for example, an S&P TSX composite index, or you own like a factor that's tilted towards more the cyclical side, like our, for example, our Canadian value ETF, FCCV, like you've seen the benefits of having that materials exposure, which, it's not as, everybody's talking about tech, the mega cap tech stocks in the US, but a lot of these other kind of cyclical sectors have done well. And actually on the international side, something to mention is like financials is the best performing sector, which is not the case, obviously, in Canada and the US. Obviously, Canadian banks have held up well, but so you're seeing this divergence in performance as well, depending on the regions, where albeit all the focus has been on tech, a lot of other things have been working, right?
Yeah, and that's why, again, if you have a diversified portfolio, you can benefit from these different areas of outperformance. You also insulate yourself from when you inevitably get pullbacks in different areas of the market as well. So certainly those that have been diversified have been rewarded in a variety of different areas, as we've been talking about in recent months. And again, to some extent, a rising tide lifts all boats, and we've seen that a little bit in the market, but certainly led by the tech space.
Yeah, no, absolutely. Well, that's great. So that's kind of our market recap. I don't know if you had anything else to add. That maybe I mean, it's hard to capture everything. Obviously, there's probably 1,000 other headlines we could have brought up, but I'm just trying to think of the ones for the average Canadian investor, advisor, kind of things that have popped up in my conversations. Is there anything else that I might have missed that you think would be noteworthy?
No, I think we've hit on a lot of the stuff that we talk about. There continue to be, I think, focus on alternatives and the way that alternative assets can be incorporated into portfolios. I know I'm currently representing the FLSA ETF, our Fidelity Long Short Alternative ETF. And again, so I think it's just these different types of alternatives continue to be an area of focus. Now, I think that's a bigger picture topic as opposed to anything that's really just come up over the last few months and market related. But that'd be the one area that certainly is popping up in a lot of our conversations.
Interesting. Well, that's great. And actually, a few episodes ago, we had I had the chance to host Rory Poole, our director of alts, and it's really interesting the innovation development that's going on there. I think there's just also a lot of education that's still ongoing with regards to like what is a liquid alternative strategy. There's more and more comfort around market makers. So hearing from Patrick even last week, so everything's kind of blending all together here in terms of the conversation around alts, where Rory's explained kind of the growth there. You're mentioning you're seeing it more and more discussed when constructing portfolios, and Patrick was saying they're getting more and more comfortable trading those types of ETFs. So I guess the ecosystem's definitely growing, which is definitely a good thing to see. So let's head on to our I guess third part of the show. It's second, really, if we exclude the introduction. Industry recap. And what a month it's been for the Canadian ETF industry. It is, I don't know if it's a record monthly inflow, but I'm pretty sure it is. 12.4 billion in September, bringing the year-to-date total to 85 billion. It's about 10 billion more than what we had as an entire calendar year last year, which was the previous record. And we've been mentioning it every time, but like we've actually crossed it now. We're way ahead, and we're likely going to finish. Like if this momentum continues, heck, we might finish, ahead of 100 billion for the year, which is unheard of, or nobody would have thought this would have been the case, 5 years ago. And obviously firms like us at Fidelity, we're benefiting from that. We're having a record year here as well. So thank you to everybody who supported that. But some of the key highlights that I noted from that actual 12.4 billion, I guess even before that, the industry as a whole. So we've mentioned right now flows and kind of how it's been growing faster and a faster pace. We're at $664 billion in the Canadian ETF industry. It's basically doubled over the past 3 years with market performance, with record inflows. It's been quite phenomenal to see. And one thing to note is about a third of that is actually held in discount brokerage accounts. So more than $200 billion are actually held by individual investors in discount brokerage accounts, which is, I think, a fairly staggering number. The rest obviously being owned by, through the advice channel or the institutional channel. Couple key points for September. Fixed income regained some momentum. It had been really lagging equities in terms of inflows, but about 4 billion came in. But thanks to our friends on the market making side, always little asterisks to help explain why that is the case. There's actually one institutional trade that represented $1.2 billion of the 4 billion.
When they move in size.
Yeah. Now that's size. And actually, that's quite interesting because we often get the question is like, how much can I trade of this product? Is it liquid enough? If you can create $1.2 billion in a single block trade, that's very telling of the liquidity, I think, of a lot of these ETF vehicles on the fixed income side. A couple other things that I had noted: international continues to lead the way, albeit the U.S. equity side has really made a comeback. Levered ETFs have actually had their largest month of inflows at $1 billion, which that's non-negligible. It was 600 something million in August, so that's really, I think, a strong continuation of that trend. Which has really been driven more on the direct side. Obviously, a lot of these products aren't necessarily kind of the typical long, you hold for 3, 5, 10 years. We had the chance to talk to Patrick about that last episode as well. And like these single stock ETFs with light leverage, you're like 1.25 times a Tesla, but then you're selling calls to offset it. Anyways, really kind of these more, let's say, fancy types of strategies, which, are maybe a bit more for trading purposes, but that's been a really popular area. And then lastly, the multi-asset category, which we really tend to shine. Obviously, you're repping FLSA.
Mm-hmm.
I'm repping our all-in-one sweater here. FBAL, FGROW, FEQT, all being in the top 20 this last month, but then also year to date. So that's really been a category that's grown consistently. Like in terms of asset inflows, it's not like the size of it. You'll never see $1.2 billion go into these, but you've seen it consistently grow. And I think there's more and more adoption from every one of those channels. In fact, and not to name exactly who we're going to be meeting with, but we have had demand from larger institutional players looking at incorporating these in like the bigger plans of retirements. How can we fit in there? Are these products that are good for the long term? Where historically you've seen kind of those more the changing asset mix type products
with a glide path.
The glide paths.
Yeah.
We have Clear Path here at Fidelity. There's others different names for it. Life Paths, Psychopath, whatever. So there's just been a lot more demand there. I'll stop talking for a minute. Is there anything else that's caught your eye? Anything there that you think is like interesting, or maybe you're hearing from your conversations when you're talking with advisors on building models that like, oh yeah, it makes sense the flows are going there?
Yeah, I think anytime you see a big momentum trade and momentum reverse over the course of the year, it's an interesting environment because the conversations you have just change so dramatically from period to period. Back in Q1, like frankly, there's a lot of fear in the market. A lot of people wanted to avoid the U.S. A lot of Canadian investors wanted to reduce U.S. exposure. All it takes is a few months and everyone forgets to some extent. And so what we've seen recently is really just a continuation of that momentum trade. A lot of U.S. growth-oriented product, a lot of these biases that we see in portfolios today, and that's really what a lot of the conversations are centered around. So it's not terribly surprising because we typically see that there's a little bit of a performance chasing element to where flows go.
Yeah.
But a lot of our conversations, to some extent, are reversals of the discussions we were having early in the year as well. And we encourage people to take, again, that bigger picture, think about diversification, and ensure that if you are tilting yourself in a portfolio towards the U.S. tech space or wherever it may be, that you're kind of asking yourself that, well, what if I'm wrong, or what if things change kind of question, and make sure that you're, at least aware of what your portfolio could do in those kinds of environments as well.
Absolutely. And it's interesting because you're almost like playing devil's advocate to a certain extent, where you're like, what if, right? Mm-hmm. What if this goes the other way? But I think, and anyways, in conversations we had in the past too, is really thinking about, is this a bias you intentionally want to take, or is this a bias that's the result of momentum that's been driven and just performance kind of shifting in certain holdings, right? Because you guys also, once you've built the model, and we'll get into the whole specifics of exactly what you guys do, but like once you've built a model, you guys are, tracking it and actively monitoring, like saying, hey, this might have changed, or this is changing, et cetera, right? So
yeah, absolutely. And, there are reasons why you might want to be a little bit more defensive in general, depending on your view, your goals, all that fun stuff. And it's okay that if you go through a market environment where you're seeing, double-digit returns over the course of a quarter or 4 or 5 months, that, you're going to lag a little bit, and you can be comfortable with that. At the same time, you want to make sure that you're not, giving up too much and being too defensive in that kind of market environment as well. So it is a little bit of a balancing act, and it always comes back to the the ultimate goal of whatever the portfolio is that we're building or reviewing with our clients.
Awesome. All right, well, that's the industry recap. We'll get to our next segment, which is answering the internet. Always a fun part of the show. So we source your questions from Reddit, other sources, like literally we've had people send me questions on LinkedIn, which I try to answer. Any way you can reach us, we'll try to answer them. So Cam, we'll go kind of back and forth answering these various questions, and I try to always pick some out, obviously, that are extreme, like more relevant, obviously, to what you guys do. I'm not going to get you to answer a question on some random ETF that you might not know about. So let's get right into it. The first one, I'll ask you first on this one. As a beginner, why would you consider using an ETF versus individual stocks? And what are some of the trade-offs that you're making there?
So I think one is diversification. A lot of ETFs, you get a basket of stocks. So you get broader exposure than just buying, 1 or 2 names. So certainly diversification. That's really a risk management tool more so than anything else. If you put all your eggs in one basket and then a company misses quarterly earnings, that can be a tough learning experience for new investors. I know I've had those experiences early in my my investing career. So certainly that's one reason. I think the other thing is, to some extent, like time and research effort that it's required to really decide, okay, this is a company or a stock that I really want to own and want to own for a long time. It can take a lot of time and effort to put the research in to determine what companies you will really want to be, invested in. Yeah. And you can either outsource that, do it passively. There are lots of different ways that you can kind of get that broader exposure to just get started. I think it's a little easier to start with more diversified ETFs than to say, okay, here's a stock and I'm going to trust a particular company with my assets.
All great points. And I think the one you mentioned also is just in terms of simplicity, right? Is like you're probably working, you're probably doing something else, or and if you're from an advisor side, right, obviously you've got probably a basket of stocks, but there's still a basket of 25 stocks relative to even the TSX 60, for example. 60 stocks, our factors have 60 to 100 names. Like, you're inherently diversifying yourself and simplifying some of the due diligence you're doing on each individual name. They all report quarterly. Like an ETF, you're not getting updated. The information is not changing as rapidly, let's say, right? Mm-hmm. So you kind of know what you're getting to a certain extent. So good. Second question, and you guys obviously do this because when you're building your models, yes, you're incorporating Fidelity products, but you're also using third-party products. So in that context also, like, how do you research ETFs? Like, what metrics do you look at when comparing either similar ETFs or, say, from one competitor to another in terms of whether it's pricing? But anyways, I'll let you expand. But like, what are some of the metrics that you look at?
So I'll start by saying it really depends on the type of ETF you're looking at. If you're thinking about like passive ETFs, then you want to really understand the index that those ETFs are tracking, how closely they track them, the fee on the product as well, because those are the areas where you're really going to see differentiation product to product. If you're looking at active strategies, then you really want to understand how the manager invests. Are they investing with some kind of style tilt? What's their investment philosophy? You want to look at the excess return or value added of those mandates. And I think in general, anytime we're doing research, one of the challenges at times is you really need to make sure that you're comparing apples to apples. Like if you're looking at a balanced ETF, you got to make sure that it's not just you got balanced in two different ETF names, but that they actually have the same asset mix, that they're comparing a 60 equity, 40 fixed income product to another 60 equity, 40 fixed income product. Because if you start comparing apples and oranges, then you can throw yourself off a little bit and kind of find misleading results. So you got to be really careful that you really understand, what you're looking at and looking for first. And then the research approach to some extent changes depending on the type of product and that you're looking at and considering.
Yeah, it was a bit of a loaded question.
There's a lot. There's a lot there.
There's a lot of stuff we can look at for sure. Actually, the point you make on the type of exposure and kind of the style bias, if you will, or like what you're getting, we see it all the time in the factor space where we have, for example, our dividend ETFs. Well, our dividend ETFs are defined by yield mostly. We use 3 different metrics to evaluate if a company is a good dividend company. 70% of that is yield, 15% is dividend growth, and 15% is the payout ratio. Some other firms will have another ETF called, the XXYZ dividend ETF, but maybe they're 70% looking at the dividend growth segment. So you're getting, ours has more of a value tilt, where that one might be more of a growth or quality tilt. And both have the same name dividend in it, 2 completely different exposures. And we've seen that, through time, even also with active managers, where some products have the name value in it, but then with the tools you guys have, like we can look at and say, no, this is not a value bias at all.
We look under the hood all the time because, what's in a name, frankly, is nothing. And so you got to kind of ask yourself, like, truly, what do you own? And by looking under the hood, getting a better understanding of if your global fund is really, predominantly U.S. oriented, or if it's truly global and has international exposure, or, if your value strategy, as you said, is like high quality, low vol, and not necessarily investing in like cheap companies on valuation metrics. These are really important considerations, and why I say like it depends on the type of product that you're looking at. But yeah, there are a couple of common areas where you can go a little bit astray, and like the fixed income space is an example, because again, depending on the index that you're looking at, the methodology, you kind of got to really understand, what goes into the product and start there. And then certainly, you want to be looking at fees. You want to look at, historical returns, categorization. You want to consider the parent companies that you're investing with as well. Make sure that you've got established companies that are going concerns, that have a history of providing product that is strong, reputable over a long period of time, that you're perhaps avoiding mandates that are really small in total AUM that have a risk or run a risk of being closed at some point in the future. So there's a lot to consider when you're doing investment research on any given product or any ETF. But that's what we do all day. I find it interesting. It can go on for hours.
Yeah. We could have spent an entire show on that question. So, but that was a great question. Thank you for submitting it. We'll take one last one, and then we'll get to our kind of more formal interview with Cam here. Which one to pick? So we once again, we try to answer as many as we can, but all right, let's do this one. I have mutual funds in some of my investment accounts. Should I switch them to ETFs?
So as an outright statement, I'll say no. Not just because they're mutual funds should you automatically flip them to ETFs. Are there reasons why you might want to, or that you should? Perhaps. But again, it really comes back to the goal that you're trying to achieve over time.
Yeah,
like
the
if
exposure you're getting.
The exposure, exactly. So, if you've got like an index mutual fund, they exist that track passive indices, and you can get the same exposure on like cheaper in an ETF, including all trading costs, then yeah, that could absolutely make sense. But you also got to think about, are these in registered accounts where you're not triggering some form of like tax consequence for yourself? Like there's a lot to consider when you're weighing just a mutual fund versus an ETF. But I would say as a blanket statement, no. Just because you've got funds, it doesn't mean you got to ditch them all and go the ETF route. Although I know we're on an ETF show.
No, that's so.
I do think that there's certainly space for both. And again, that doesn't necessarily mean you can't incorporate ETFs into what is today a predominantly mutual fund focused portfolio.
And I think, and this question comes up a lot, so that's hence why I kind of added it in there, because a lot of people associate mutual funds with active and then ETFs with passive, which is like half of my time from the first 4 years I was doing this was kind of debunking that myth, right? And they're both investment vehicles that have the same flexibility in terms of strategy that they want to have. So it's not because, like you said, you have a mutual fund that necessarily you can find something better on the ETF side, or even, likely there's a chance that mutual fund might have could have outperformed another ETF they're looking at. So it's really all about the exposures you're getting and not trying to differentiate one vehicle from another. No, but that's great. So that's answering the internet. And now we're going to get to our last segment of the show, which is kind of our more formal interview. Cam, some people that are listening today might have actually probably heard you on some content we produce, whether it's Fidelity Connects, Upside. I mean, we do so much stuff now, and obviously you've been, you've played a pivotal role in that and appearing on those shows. But for our audience that hasn't had the chance to, hear from you and kind of your story, like how did you get to where you are now at Fidelity, and what's kind of been the career path, and maybe tell us a bit more about kind of what your day-to-day looks like.
Yeah, so my team at Fidelity is focused exclusively on building investment portfolios and analyzing investment portfolios for our clients. So this service has really come about because over the years we started by kind of launching a tool and a platform that helped take a deeper dive into investment portfolios, similar views that our portfolio managers at Fidelity have access to.
Mm-hmm.
And so we started just running analytics on hundreds and frankly thousands of different portfolios. And over time we were asked, rather than just telling us what we've got today, could you help us really improve this, build something from the ground up? So that's really what my team, Fidelity Portfolio Solutions, is here for. I first started with Fidelity as a student back when I was in university, and really I've been here ever since. So my roles have always evolved kind of within our product team, but I love working with Fidelity, the people here, and so really excited that I get to work with so many great folks, really coast to coast, like yourself.
No, that's awesome. And it's really been interesting to see like the growth on your guys' team. The absolute demand, I think, from the obviously you guys are working with advisors 100% of the time, right? Helping to build those types of models. But, these insights could be applied to, any type of investor. But the sheer demand, I think, just because markets have gotten more complicated, there's more products, there's more asset classes, there's more things that we can look at as investors, where it's almost become kind of like a no-brainer to bring in some resources like your team to take a deep dive, make sure we're hitting in all the right spots. And it's been wonderful to see. And obviously I've had the chance to work with a bunch of people on your team over the years, and it's really a great group. So thanks for sharing that.
Yeah, and I think it's like taking your car into a mechanic for a tune-up or doing an annual physical. Like there's no reason not to get a second opinion and just make sure that your portfolio's as robust as you think that it is, and that's really what we're here to help do.
Yeah, I like that. I love metaphors. What gets you excited to go to work every morning?
Well, I already mentioned one of them, and first off, I'll just say the people. So every day you get to go up, get up, go to work, and I thoroughly enjoy the people that I work with at Fidelity. I love the people I'm working with, the people on my team. So that's one. I think the other piece, of course, is that the market is always changing, and so there's certainly a stimulative element to the role where you're not just thinking about what's going on in the market, but you're thinking about different viewpoints. Like I often find myself trying to challenge my internal view and say, okay, if I'm bullish on whatever market it may be, well, what's the reason to be bearish? Because the reality is that you have to have both views to make a market. So there's always going to be somebody out there that should have the opposing view to yourself. And so understanding, what they're seeing, why they would have that view, and kind of put yourself in their shoes, I think helps get you a better understanding, especially when we're looking at diversified portfolios and that kind of guidance. We talk to people with all these different views, and so it's not always about just arguing and being a contrarian for the sake of being contrarian, but really making sure that you can understand kind of both sides of the trade, whether it's a macro oriented trade or something that's more micro as well.
And we know that like that I guess ideology, or like that, the way that we always kind of do that as a team, and like even as like we're on separate teams, but we work together quite a bit. Obviously, ETF and portfolio solutions teams, like why can't we challenge each other on certain ideas? And it's actually that comes from like way at the top of the firm, where it's like you have some PMs that are long certain names, some are maybe short that name, and that's just kind of I think very reflective of the kind of critical nature of thinking that we have here at Fidelity, which is definitely to your point, one of the fun parts about working here. Let's get into kind of the more nitty gritty. Let's get into the meat of the, let's chew on the bone a little bit here.
Hit me.
What's the most common risk that you guys come across? Like when you're analyzing these hundreds, thousands of portfolios, what's the most common risk that comes up in those said portfolios?
So I'd say right now, really, there are two. I'll give one on the equity side and one on the fixed income side. Perfect. So on the equity side of things today, it's definitely like U.S. growth and specifically momentum. And we differentiate between those two factors because they're not fundamentally the same thing. You go through periods where momentum, like back in 2022, it was in low vol Canadian stocks. It was like that was the momentum trade. You don't see that right now. Right now, the momentum is in the U.S. growth space. And so certainly we see that reflected in the portfolios we are reviewing. Now, again, that changes over time. And if that change is being made deliberately and actively, then that's fantastic. But we got to be cognizant of it and understand what happens if that trade were to unwind itself, because it has at times in recent past. And then on the fixed income side of things, we continue to see really a fair bit of credit exposure. So a lot of fixed income focused investors or balanced investors who have dedicated fixed income products have tended to move away from traditional investment grade focused kind of longer duration, higher quality bond products, which again is fair, but they've typically moved towards products that are kind of down the credit quality spectrum, so high yield, and as a result, you tend to see higher correlations in periods of substantial market sell-offs, recessions between kind of the high yield bond market and equity markets. So it's not that it's a massive concern today, but it is definitely an area that I think thinking is going to continue to need to evolve, and portfolios need to be evolving over time if you're depending on the risks that you're trying to manage. And so those are definitely two biases on the U.S. growth side, and then on the kind of high yield credit side of things that we've seen a little bit more frequently in portfolios of late.
Okay, I like that. It's just to add on the credit side, that's really an interesting one, because it feels definitely since like the pandemic, like we've kind of always been expecting spreads to say, okay, this has been a great trade. At one point, spreads are going to widen. We kind of saw it for like a month this year, and then tariff pause spreads come right back down. And once again, that's the trade on the fixed income side that's outperformed, if you will, if you split it up by different sectors or parts of the fixed income market. And we've always kind of heard, even from some of our active PMs, saying like the maturity wall's been pushed back. A lot of these companies issued longer term debt, post the pandemic. We're kind of good until 26, 27. We're getting pretty close.
You start to get close,
but rates have come down. So hopefully new issuances, it's kind of more like that risk is there, but like to your point, it's kind of like, we've kind of found a good way as a market to navigate some of those risks. It feels like there hasn't been like a big spread widening event, even through the volatility we've seen on equity markets.
Yeah, and certainly not one that's been longer lasting. And I think that's what is always important to consider here is we've seen a lot of market bottoms in recent years have been pretty sharp V bottoms. And so you haven't seen a more prolonged period where spreads have really widened and stayed wide. And I'm not suggesting that that's going to happen immediately, but I think it is a risk in a lot of the portfolios we see that I think is underappreciated right now. And again, it's been a great trade. You look at returns over the last few years, and certainly like the high yield bond market has outperformed investment grade bonds, no doubt. But you got to be careful. And a lot of the time, when you have a high quality fixed income exposure in a portfolio, you have it for a reason. It's typically for risk management. It's insurance. And that wasn't insurance in 2022. And so people anchor to that. And you got to be a little cognizant of your anchoring bias and make sure that you're thinking about, well, what if the next sell-off or period is different than the last one? We'll see what it ends up being, but that's definitely an area that we keep an eye on.
And anchoring bias is like rings a bell from like behavioral finance class that I remember for a while. So we're even bringing psychology into this discussion here. No, that's great. My next question is, and it's kind of I guess, what are like top 3 tips that you would give investors, advisors when thinking about building a model portfolio? Not that I want to take job away from you guys, but you guys are busy enough as it is. So maybe share with our audience kind of some of the things that you look at when building a model.
Yeah. So, I mean, I'll say the first one is obvious. It's, know your goal, your risk tolerance, your time horizon. Like that kind of goes without saying to some extent, but you really have to understand why you're building the portfolio to know the type of portfolio that you need to build. I'd say the second piece is really, first off, then understanding either what you own or what you're considering owning. So, and what I mean by that is, as we talked about earlier, you can have lots of strategies that don't give you a lot of information in their name, or it can be difficult to understand what you're buying. Covered call mandates, just because you got like a U.S. equity covered call product doesn't mean that it's necessarily a diversified strategy. A utilities covered call might own 5 underlying names. So like you really need to understand what the product is that you're considering incorporating into your portfolio to fit into that kind of asset mix that you're targeting for yourself. And then it's what we've talked about a lot, and ask yourself, what if I'm wrong, or what if things change, and understand, are you protected against, essentially being completely wrong if you're bullish and all of a sudden you get a bear market environment? Do you really understand how much drawdown risk that there is in your portfolio, or are you really kind of set up across the portfolio for one particular outcome? So again, those are higher level
tests almost, right?
If you're stress testing yourself, you're thinking about, okay, we got to pull back in the tech stocks. What is working for me in that environment, and what would I maybe expect would also happen in those environments? Like, do you expect credit spreads to widen? Do you expect the rest of the U.S. market to maybe sell off a little bit? Could that be a pause on some of the international trade that we've seen lately? Do you have a component in your portfolio that's working for you? So those are kind of the three high level things that we would kind of ask ourselves. Make sure you understand your goals, what you own, and what if you're wrong. And then when you actually start to get into the research elements of what strategy actually works for me, then again, it depends on the level of simplicity that you're looking for in your portfolio, and that can help serve as at least a starting point to actually get going.
Okay. Those really good tips. My next question is around, we actually kind of touched on it a little bit earlier when talking about different vehicles, mutual funds, ETFs. Like when you guys are building portfolios, you're looking at, asset classes, geographies, styles, etc. What about like management styles? So like, is there areas that you absolutely, like for example, never consider using passive? Some areas where you never consider using active, or vice versa? Like, is there areas or tendencies that you see from a market standpoint for either one of those two types of approaches?
Yeah, we see occasionally both used in pretty well any environment, again, depending on how you want to build your portfolio. What I'd say is we more commonly see passive exposure be incorporated for just U.S. large cap exposure, and using the S&P 500 tracking ETF as a component there, and then adding more growth oriented exposure around it, or something that's more low vol or dividend exposure around that. Same thing you see in Canada with like the TSX 60 tracking ETFs are quite common. Where we see them used less often, in the small cap space, in international markets, in particular in emerging markets, we see more active exposure. The fixed income market, I think, is an interesting one, because we see a little bit of both for two different reasons. Some will say, well, I just want to own bonds, so I'll do it as cheaply as possible. I fundamentally think that you kind of don't want to just invest in whoever the biggest issuer is, and so that's a bit of a challenge there that you got to weigh as well. And so looking at more systematic ways that you can invest in especially in the investment grade bond market, and then on the credit side of things, I think really want to have active managers there that can go through and credit select for you more appropriately. So the passive space we definitely see more heavily utilized in the larger cap North American markets, in Canada and the US, but I'd say less so in other international markets and in the fixed income space.
Awesome. Last question for you, because we're at time. These things always fly, and we could go on and on. We have no issues doing that. Right now, or maybe just longer term picture, what's your favorite ETF at Fidelity? I mean, you could rep FLSA, but is there one that you like right now for a particular reason? It doesn't have to be like necessarily from like a market performance standpoint, just maybe more even from like a construction, or what's your favorite ETF right now?
I would say, to be honest, FEQT, the all-in-one equity. I'm a little bit of a nerd. There's a nerd in me for sure, and so I like the methodology, the factor components, the elements of active management in those areas where there's historically a tendency for active managers to have higher likelihoods of outperformance. And ultimately, I think that having kind of that broad-based diversified exposure on a global markets from a global market standpoint certainly resonates with me. So I would pick FEQT, but there are lots of good options.
I like that. Core, well-built, well-diversified. Thank you so much, Cam, for joining us. It's been a blast. I'm sure we'll have you back on in a future episode. We'll try to make this a regular thing. And obviously, as markets move, so is what you guys are considering, and as risks and all the different construction ideas, if you will, around portfolios. So we'll definitely have you back on. Thank you, everybody, for tuning in. It's been another great episode. You can catch our previous episodes on YouTube, your favorite podcast app. Thank you so much for your support, and we'll catch you next time.